Okay, key points. We'll start by defining EV over EBITDA. We'll take a look at some examples. Does it work? Does it actually help investors generate superior returns? We'll look at some of the positives of it, some statistics from backtesting it. Then we'll take a look at why Charlie Munger, Warren Buffett's partner, called it a BS tool and why he doesn't like it. So we'll look at some of the criticisms of it. And then we'll apply some usage of it to a screener, see how traders can actually use the indicator using stock screeners to find stocks that may be undervalued based on EV over EBITDA, as well as some pitfalls and some things that investors should bear in mind. Okay, EV over EBITDA defined. The first thing that I'd like to mention is that this tool originates in the private equity world. So the way it came about, so to speak, is from the perspective of investment banks and companies looking to acquire other companies. So let's say there's a soup company that wants to buy another soup company or wants to buy a manufacturer of cans, some related business. They're trying to understand what's the real price they'd have to pay to acquire this company, as well as is it worth it, and that's where the ratio comes in. EV over EBITDA, the lower the number, the better. It's just like valuation. It's very similar to the price to earnings ratio. In fact, one way of looking at this is that this is just like price to earnings, but it's more applicable in a takeover or in an acquisition type of environment. So from the perspective of a public market investor, where this could be even more valuable or where it may make a lot of sense, is if you are employing a strategy where you're looking to buy companies that are acquisition targets. So EV over EBITDA may help you identify companies that are likely to be acquired. Often when companies are acquired, there's a big pop in the share price. So from that perspective, you could say, all right, these companies look like they're likely to be acquired, or if you think there's a lot of consolidation going on in a given industry, you may use EV over EBITDA to find likely takeover targets. So that's one way sort of the indicator could be used, and that's sort of the idea where it's coming from. Okay, now into the actual calculation. The numerator is enterprise value, and the denominator is EBITDA, earnings before interest, tax, depreciation, and amortization. So let's start with the numerator. Enterprise value. This is when a company is buying another company, the total cost it will basically have to pay. So I think enterprise value is a little misleading. Enterprise price or takeover price I find to be a little more descriptive. And basically the way that works is the market capitalization, so buying up all the common shares, that's one component. You add to that preferred shares, which are shares that are not really reflected in the market capitalization but are still reflective of owners. Preferred shares are often thought of as similar to debt because preferred shares shareholders get paid out first. Minority interest. This is a percentage of, if a company owns another company, owns like 20% of or 40% of another company, but doesn't own that 60%, then that's sort of a minority interest that needs to be factored in. So you basically add in shares of subsidiaries that it doesn't own. If you're factoring in the earnings of that subsidiary, but you're not factoring in the shares, you sort of assume that it's going to buy out that. Or it's a way of balancing out earnings from a subsidiary that you're factoring 100% of the earnings, but you don't actually own 100% of the company. So minority interest is a little more involved, but that's something to think about. Basically, it deals with subsidiaries. If you don't own all the company, buying out or adding in the percentage that you don't own. Total debt, this is a little more intuitive because when you buy a company, not only do you have to buy up all the shares, but you're also buying the debt, basically. So you have to find a way or you have to add that in. Now, there are some ways around this. You could negotiate the debt at a lower price or something like that, but that's something that generally you have to bear in mind. Unfunded pension liabilities. So again, we're trying to account for all the debt that the company has, right? Because if you're buying another company, you need to buy the shares and the debt. Unfunded pension liabilities are a type of debt, just like preferred shares are. Technically, it's equity, but it relates to the idea of debt because you have to pay them first. So unfunded pension liabilities, that's a debt that's not going to be reflected on the company's balance sheet. Associate companies is sort of the inverse of minority interest. It's companies that the company that you're looking to acquire has a share in, but you can easily sell that. So you subtract that, as a way of, you subtract associate companies because this is, a cash equivalent basically. And likewise, you subtract cash because when you're buying a company, the cash you get, if a company costs $10, but it has $8 in cash. Well, you pay $10, but you got the $8 in cash right back. So really, the true price was $2. That's just a real simple example. We'll take a little slightly more involved example coming later in this video. So that hopefully illustrates the numerator enterprise value. The main thing is that it's a takeover price, right? So that's sort of where it originates from. That's sort of the perspective. Enterprise value is the price that if someone wants to buy the company, all the costs they're assuming, as well as the shares. Over EBITDA, which is earnings minus, or it's earnings, but doesn't include interest, tax, depreciation, or amortization. So why does it not include those things? Basically, it's a way of looking at operational income. So you're looking at, if you were to buy another company, a lot of things like taxes or interest or depreciation, amortization may change. So you're looking at, all right, what does this business truly earn just from its operations, right? Because when you take it over, a lot of the other intangible sort of things or non-operational earnings are going to change. You're going to combine operations. That may impact depreciation. It may impact how you calculate amortization. The whole accounting structure will change. And a lot of the operation costs will change too, but EV over EBITDA is an idea of like, all right, well, here's sort of what the company's core assets are generating. And enterprise value is what is going to cost us to pay for it. So it's very similar to price earnings. Okay, now let's look at a sample EV over EBITDA calculation. In previous videos, in our valuation videos, price to book, price to cash flow, price to earnings, we've talked about a sample lemonade stand. Let's stick with that example. Let's imagine this lemonade stand that we've been discussing is now a potential acquisition target from a lemonade stand in another neighborhood. Let's say there's a conglomerate of lemonade stands in nearby neighborhoods. They're looking to expand to the lemonade stand that we've been discussing, looking to acquire it. So if they wanted to value the company, understand its operations better, they might do an EV over EBITDA calculation, and let's see what that calculation would look like. The target acquisition here has cash of $50, cups of $5, sugar worth of $10, lemons worth of $10, debt versus $10, and the shareholders are valuing their shares at $50. Let's ignore the idea of unfunded pension liabilities. Let's say there's none of that. There's no minority interest. There's no associate companies. So here's sort of the basic calculation. Okay, what we would do is we'd calculate the total shares, right? So in order to buy the company, we'd have to pay $50 for the shares. They also have some debt, so we'd also have to pay off that debt. There's $10 worth of debt, so that gives us $60. Of course, we can subtract out the $50 in cash we're getting right back. So that gives us 10. The cups, sugars, and lemons are assets that we're getting, but they don't really factor that in. So, and this also relates to how a company would do its accounting or how you would value it. If you thought that these were cash equivalents, that you could sell them right away, you may want to factor them in. And if you did, your EV over EBITDA would be negative. But in many instances, the assets that you don't think you can easily convert to cash, that you would not say are cash equivalents, you don't factor them into the calculation here. So really, enterprise price here, enterprise value, is $10, right? And you're just getting these assets. So that's something to consider. The reason I mention them here, and they're a little bit smaller font, is that they're still of some value, and when you're thinking about it from an acquisition standpoint, you're thinking, all right, I'm getting these lemons, I'm getting cups, I'm getting sugar, and I'm still getting $50 in cash. But so the enterprise price, the enterprise value, is $10. We took the shares that we had to pay for, we added the debt that we're buying, and we took out the cash that the company has. That gives us 10. 50 plus 10 minus 50 equals 10. Now, EV over EBITDA, the denominator, EBITDA. Let's look at its operating earnings. It had a revenue of $40 in the period that we're tracking, last 12 months, let's say, minus the cost of goods, right? The cost of the cups and all that stuff is $12. Operating expense, maybe a chair or some signs or something like that, something that's not really related to the production, directly related to the production of lemonade, but it is a cost of the business, that's $8. So 40 minus 12 minus 8 gives us 20. From there, we can calculate our EV over EBITDA. 10 over 20 is 0.5. Or if we invert it, like we do with price earnings or a lot of these valuation ratios, a lot of people tend to invert it, you get EBITDA over EV, that gives us 2 or 200%. And the reason you invert it, or when you invert it, you can compare it to other assets and other yields. So you can compare it to what's a government bond yielding. For instance, if a 10-year government bond is yielding 3% or 10% or 5%, 1%, whatever it may be, you can compare it to that. You can say, all right, I'm taking on this risk of investing in this company, but its earnings yield is 200%. So EV over EBITDA is half, though, and the primary ratio, EV over EBITDA, is 0.5. Conventional rule of thumb is that EV over EBITDA under 10 is good. Now, that's just a conventional rule of thumb. I personally don't give that too much credence, but it may be something to bear in mind or something to think about as just a benchmark, a rule of thumb of sorts. But here's sort of the basic calculation. EV over EBITDA can be negative, right? So if, for instance, the company has a lot of cash and its share price is less than the amount of cash it has, then you may actually have a negative enterprise value, in which case it would be a good buy. Often if a company has a price-to-book ratio of under 1, it may also have a negative enterprise value. And if you watch our price-to-book ratio, you can sort of see how that's related. So that's sort of the basic idea behind a sample EV over EBITDA calculation. Now, does this, after we've discussed all that, does this stuff actually work? Well, James O'Shaughnessy, an investment manager, fund manager, he conducted a study, investigated this a little bit. His data set was U.S. stocks from 1964 to 2009. He found the lowest 10% of price to earnings ratio, their compound annual return was 16.3%. The lowest 10% of EV to EBITDA compounded annual return was 16.6%. So the takeaway here is that EV over EBITDA does slightly outperform PE ratio. So if you think PE ratio makes sense, it's something you value, EV over EBITDA may slightly outperform that. Now this does relate to one issue with EV over EBITDA, which is if you go to actually put it into use, because of the way the enterprise value and even the denominator, but to a greater extent the numerator enterprise value is calculated, you'll get all sorts of different answers. So, for instance, let's just see what it says on the internet. EV over EBITDA, ycharts.com, that's a company that has a lot of great information, really great website in my opinion. They're saying Amazon.com has EV over EBITDA of 31.91. WikiInvest says Amazon has an EV over EBITDA of 33.9. Yahoo Finance says EV over EBITDA is 36.14. And Guru Focus, a product I use, is saying Amazon's EV over EBITDA is 31.85. So, there's going to be some discrepancies. A lot of this is based on when they calculate the share price from, because the share price is going to determine a lot of the numerator, a lot of the market capitalization of the company. But there's some pretty big discrepancies here. In just the case of Amazon, we've seen a range of 36 to 31, or a little more than 31. So that's like a 15-20% type of range, which is pretty significant, and that relates to one of the difficulties of using the screener. And perhaps for this reason, you won't see a lot of screeners don't offer it. One of the reasons I like about Guru Focus is that it does have EV over EBITDA. A lot of the common ones, UncleStock.com, Finviz.com, GoogleFinance.com, or Finance.google.com. They don't have EV over EBITDA, partially or probably because it's the way it's calculated. It's an odd calculation. Guru Focus does have it. That's not to say because of the way it's calculated, I'm personally not a huge fan of it. But you can get some ideas from it. Here's a sample screen I have up, and the screener's all in one screener. Went to valuation ratio. Said, show me all the EV EBITDA stocks that are under 10. Then went to the fundamental tab. Have a market cap of at least $1 billion, and I excluded OTC stocks. So these are companies of a reasonable size, which suggests a little bit more price stability. You can make the market cap even higher if you want. Exclude OTC stocks, make it exchange-traded stocks only. And here's some things. We see some really negative EV over EBITDA. So maybe these companies have, a lot of cash relative to their share price. So potentially interesting companies. We can make it even, let's say we want even larger. Let's say we want to deal with pretty large companies, $20 billion market cap. Nokia, some interesting companies here. So this can give you some ideas. as to how you would screen for it, then drill deeper and say, all right, let's see how these companies are doing, whether it's actually worth it or not. And that's sort of about it. Basic introduction to EV over EBITDA. Hopefully gives you some ideas and understanding of how it works. Any questions you have, anything you want to add, join us at informedtrades.com. Best of luck in your trading, and we'll see you next time. Take care.